The market is back to all-time highs despite recently high inflation, tariff concerns, Russia, Ukraine, Middle East stuff, and so much more. And yet the market finds a way back to the all-time highs. This is the resiliency of the US stock market. But it's not just the US stock market this year. Take a look at the DAX. The DAX is absolutely ripping here, up 1.2% today. You've got Chinese stocks on the move as well. And by the way, Brazilian stocks, a really big winner here recently. So you've had all sorts of really strong moves for global stock markets. The S&P 500 is also up this year, but actually lagging behind some of the other ones. This is actually, I would argue, a pretty good sign to see other stock markets participating in the recent rally. But sentiment is a little bit different. Take a look at the AAII Investor Sentiment Survey, which asks traders and investors how they're feeling about the stock market, specifically the US stock market. And you can actually see that 47.3% of respondents said they're feeling bearish, with just 28.4% responding saying they're feeling bullish. So the interesting divergence here from the price action of the market and market participation sentiment is very interesting to me. People are feeling bearish even though the market is moving higher. And usually this would actually be, in my opinion, a bit of a bullish indicator when everybody is getting bearish, but not so fast. There is a reason that in the Edge Finder we track multiple sentiment tools. Let's also look at the put to call ratio, and it tells a different story. What you can see here is that the put to call ratio, which tracks the volume of puts relative to the volume of calls in the stock market options market, is actually showing a huge demand for calls right now in the stock market, telling you that in actual trading volume, people are very bullish. So why is this so different? Well, here's what I would attribute this to. Number one, politics. People are uncertain about the political landscape right now, and people who may not be happy with the current administration may just suddenly feel more bearish on the market, and people who are feeling more happy about the current administration may suddenly feel more bullish on the market. That is typically what people do. They vote with their politics, both in the polls and also in the market. But what I find more important than investor sentiment, which is a survey, is the actual volume in the market. The put to call ratio, in my opinion, is more valuable than the investor sentiment survey because it shows people's actions and not just their feelings, right? This is actual volume in the options market. And what we see is huge call demand. People are very bullish. And so when we get to such an extreme like this, which is, a recent extreme in the put to call ratio, that tells me it's time to get cautious. It's time to back up and just wait on indices, especially because, again, they're at all-time highs. People are feeling euphoric. They're feeling very bullish about what's going to happen next. And so I think expectations are really high. It doesn't mean that I'm bearish, but I think when everybody is bullish, there's time for me to just kind of wait on the sidelines for either a larger pullback for a possibility of buying the dip, or if I miss the initial breakout, I could potentially look for a breakout and retest of this area. But what happens if there's just a major breakout to the upside and it never comes back for me? Then that would be part of trading, and it happens to me sometimes where you miss the move and it just runs without you. So, that's how I'm going to approach this. I'm going to approach this cautiously when it comes to the indices. NASDAQ, S&P 500, Dow Jones not too far from its all-time highs, but most of them are close to it. The Russell's lagging behind here, down 0.21% today and kind of flat and ranging in this recent area. But I do think that this has potential room to continue. In fact, what I'd be looking for is a larger pullback in markets and actually to possibly get long the Russell as well. So just wanted to share some sentiment because, again, it can be a little bit confusing sometimes. Why are markets at all-time highs? Well, again, yes, there's tariff concerns and there's inflation concerns, but sometimes the market just gets hyped up and keeps running. Sentiment gets really high to the upside, and sentiment can be a driver in the short term. But I do think in the longer term that there is probably some pullbacks and some opportunities to still get involved without having to chase this market higher. In the meantime, I still really like silver and gold. Both are getting a +10 score on the Edge Finder, which means after looking at economic data, technical reads, and sentiment data, there is a very strong confluence pointing towards bullishness for these things. And this has been a really good signal here recently from the Edge Finder, and I still remain bullish on these things. I specifically have a silver long position that I'm still working with. By the way, if you're interested in trying out the Edge Finder, there's a 30-day trial link in the description down below where you can get a chance to try out the software for a full 30 days, and your payment for that 30-day trial gets credited towards your final purchase. This allows you to try out the software before you fully commit to the full price, and it also allows to pay for our team's time to administer the trial, answer questions, and work with you on a one-on-one basis. If that's something you're interested in, use the link in the description down below to apply for a trial. When we look at the price action for gold specifically, we can see momentum still is very, very strong for this chart. We had Friday's mini kind of sell-off here and a little bit of a bounce back here today. I'm curious to see how price action closes. And I'm going to go ahead and say this. I think that a lot of people are waiting for this move to happen on gold, and I would not be surprised if the market just did this instead and just kept going and going and going. The markets have a really creative way of frustrating the majority most of the time. And I think a lot of people think that gold is going to have sort of a big mini or a big correction rather than just these little mini ones that we've been seeing. But I would not be surprised if these mini ones are all we're going to get for a little bit until we get more solid kind of news on the tariff side of things. So I actually think that mini dips here might be kind of the majority of what you get. That being said, I would be interested if you do get a bigger pullback in buying it myself, especially at this previous all-time high. From a longer term basis, if I draw a Fibonacci retracement from swing high to swing low, it's somewhere in the neighborhood of a 38.2 to 50% retracement on the price of gold. I'd be interested if we do get that kind of retracement, but we just, like I said, might not get that for a while. And I've been discussing a lot recently my silver long position, which dipped here slightly on the Sunday market open, but has bounced back today. I'm curious to see if we can get some follow through to maybe recapture some of those previous highs and continue higher. And I do also want to reiterate kind of my theory here. I like silver quite a bit. It is an edge finder setup currently, and my stop loss is now tightened up to just below this 50% retracement off this recent high. My goal here, like I said in recent videos, is to see if we can get a closure above this previous high, in which case I'd look to lock in something on the trade. So I'm looking for that kind of move. We may get it here today, we may not. We may get it here tomorrow, or we may get a complete failure, in which case I'll take a small loss. I'm just going to work with this silver trade. This is my first attempt on the position, and if it doesn't work out, I'll look for a better opportunity to maybe play it again later. As long as I continue to have a bullish reading on the edge finder, I'll be looking for silver setups. The dollar index is also a bit of a mixed bag here, and I actually had a conversation today with Ivan on the live stream, which you might find useful on this subject. Check it out. Today's video is sponsored by DNA Funded. If you haven't already checked them out, DNA Funded offers up to 90% profit share. You can also trade up to 800 different assets, all in a single prop firm, and they have a very smart and capable team behind the scenes. We've spoken with them, and they seem like a really powerful group. This is also a spinoff from DNA Markets, which I think adds a little bit of extra kind of validity there. I personally like when I see brokers that are also creating prop firms, because then you know there's professional teams behind the scenes that are running it. Of course, do your due diligence, but if you decide that DNA Funded is right for you, use our promo code A1T10 for 10% off any of their challenges. We kind of have to think about, and for me with the dollar, I'm thinking about where we were a few weeks ago. We did also have hot inflation data from the previous round, and we had retail sales hot, we had jolts strong, we had everything strong. Now we're shifted a little bit. Yes, we still have hot inflation, but we've lost some of the other story. We've lost some of the jolt stop jobs and things like that. To me, I also think that the story is difficult right now because of what we discussed earlier with the tariffs, right? We just don't know where that's going. And tariff de-escalation is bearish for the dollar, as the market's been telling us, and tariff escalation fears are clearly bullish for the dollar. So I don't really know where we go with that. I think that the market right now has priced in like good news for tariffs. Like they're now starting to think like, oh, they're not going to be that serious or that. So I do worry that from a dollar bullish perspective, that tariffs could come out of left field again and start presenting some issues. In 2018, I discussed this earlier in the stream. It was kind of the same story. Like people kind of shrugged off trade war stuff, like it was going okay, and then all of a sudden relations with China really worsened, and it caused a meltdown in stocks. And so we have to be aware that like relations on the tariff stuff are still forming. It's too early to call like, oh, tariffs are okay or tariffs are bad. Like it's a difficult story to try and predict. So that's where dollar is difficult for me. I wouldn't say I'm bearish on the dollar. I just also wouldn't say that I'm as bullish as I was over here, where you had higher highs, higher lows, and all the data kind of lining up. But, you know, inflation expectations are still elevated. When we take a look at like the 10-year, right? we haven't like really crashed on this. If it starts really taking out the lows, then dollar index is probably going to struggle a little bit, because this would indicate that the Fed might actually start cutting rates. But there's so much tariff noise in here, it makes it hard to really try and forecast, Ivan.
Okay, so how you talked about mentorship a bit earlier. So how do you get to the core? How do you get to the real core of the? I'm on the wrong screen. Sorry. How do you get to the core of everything? I always say to whoever wants to listen to me is CPI, PPI, and CPI, PPI, and PCE is always going to be the most important. So consumer price core went up to 3.3, up from 3.2. We went up to 3 from 2.9 on the CPI. We went from 3.5 to 3.6, corrugated to 3.7, so it went down, but still, it's higher. And from 3.3 to 3.5 on the PPI. And then PC is about to come out, but it's currently at, it's about 2.6. So PPI and CPI came out for this month higher than expected, or in a higher region. That for me alone is enough to stand strong. Now, I haven't remember what the services PMI is on top of my head, but
PPI I think is 3.5.
Okay, so service PMI came out quite weaker, but still above. So I still talk about a dollar bullish case as if that's, as I'm totally convinced with my entire body, and there's no doubt with that story, because I've done that before, not necessarily done before, but back in 2022 when we broke the 3 level. Not that that's a bad thing, but that's, for me, it's a kicker. Like, you can't cut interest rate in a 3% environment while you're having an interest rate about 4% for 25 or so. So for me, higher inflation makes them pause. I would argue that we should not price in any rate cuts this year. That's beyond or on top of or beside of the trade war. And if we add that on top as well, maybe we see 4% inflation this year.
Yeah, I think that's a fair point. And I think that's why it's for me, it's difficult to really get on the, I'm super dollar bearish themed either, because again, you've got that kind of backdrop of uncertainty with tariffs. And so, yeah, I mean, it's difficult. Many traders don't know this, but a lot of trading profitability is dependent on you using the correct brokerage when you're trading. Remember that your trading costs are an input to your trading results. So what I mean by that is trading costs such as commissions and spreads and swaps and overnight holding things, all of that plays into your final results as a trader. And another huge thing that I cannot emphasize enough is you making a deposit into a brokerage account can earn you some significant trading perks if you use the right offer links. In the description down below, we have put together a collection of some of our partnered brokers that offer welcome bonuses when you make a deposit, free stock shares when you sign up, and access to some of our products for free. On our website, a1trading.com/brokers, that's a1trading.com/brokers, you'll see a list of free offers that you as a client to these brokers can get upon sign up and deposit. Do not make the rookie mistake of just signing up for any brokerage and not using a specific offer link. If you use our referral links, you'll get something out of it, and you'll also be supporting our work here on this YouTube channel. Thank you for watching. We'll see you next time.